Operators send a 40-page proforma and most investors open it, they feel overwhelmed and either pass on a great deal or say yes to a bad one. Here's the math. 95% of that document is noise. There are exactly 5 lines that tell you everything you need to know. And once you know them, you'll never read a proforma the same way again. Line number 1, growth potential rate. This is what the building makes if every single unit is leased at full asking price. It's the ceiling. Line number 2, vacancy rate. This is what the operator assumes they will lose to empty units. If they're projecting 3% vacancy in a market where historical average is 8%, they're lying to you with math. Red flag, walk away. Line number 3, NOI, net operating income, revenue minus operating expenses before debt. This number tells you if the asset itself makes money before the operator's financial structure make it look better or worse than it is. If the NOI is thin, no amount of creative leverage fixes it. But here's the line that most new investors completely skip. Line number 4, the return projections, IRR and cash on cash. But here's what nobody tells you about these numbers. They are not fact, they're just assumptions. Every IRR projection is as honest as the rent growth, expense ratio, and exit price that the operator plugged in. Change any one of those just by 10%, and your 18% IRR becomes 11. Same deal, different story. Line number 5, the exit cap rate. This is the rate the operator assumes they will sell the building at years from now. It sounds technical, but it really isn't. If they bought a 5.5 cap and they're projecting a sale at 5% cap, they're betting that the market gets more competitive by exit date. The best operators stress test this. They model what happens if the exit cap is higher, meaning if the market got worse. If the deal still works, it's a real deal. And if it doesn't, it doesn't. Here's the twist. The exit cap is the single most manipulated number in every proforma you will ever receive because it's the furthest thing in the future, is the easiest assumption to inflate, and it has the biggest impact on the projected IRR. Operators know this, and the good ones made it conservatively. The bad ones use it to make a mediocre deal look exceptional on paper. The moment you know what to look for, you stop being the person who gets sold a story and you become the person who reads the room every single time. Growth, potential rent, vacancy rate, NOI, return projections, exit cap rate, 5 lines, that is it. The other 35 pages, just context, details, noise.